What's poppin'? Welcome back to another video. So you're looking at how to trade options on Robinhood. Maybe you don't understand it because it is very confusing. So today I'll be taking you how to actually trade options on Robinhood. So today is Saturday, so the things I do won't go through, but it's exactly what I do when I trade options. So what is an option? First of all, so an option is a contract or the option to buy 100 shares of a company at a certain price. Options have expiration dates, so it's a contract, so it has an expiration date. So the expiration date really values your option, and when your option is valuable, you can trade it, which is what I do. I never actually exercise the option, which is buying the 100 shares. So if you're already confused, let's backtrack a little bit. So how do options hold value? So there's two types of options: a call and a put. A call means you think the stock is going up. A put means you think the stock is going down. You can choose to buy a call, which is you buy it up front, you pay the money up front. You can only lose however much you bought the contract for. If you do a sell, which I don't ever do, so you can buy call, you can buy put, you can sell put, you can sell call. So on the Robinhood, so let's hop into the Robinhood app. Let's go trade some options. So let's trade a AMD option. So if we go to AMD, right? So say AMD right now is at 47.64. Say you think it's going to go up to $50. So you press trade options on Robinhood, right? You always want to never be too close in expiration. Like if you really think it's going up that fast, then you should be safe with the March 13th option. But here's the thing: the option value, when it gets closer to the expiration date, will either drastically decrease or drastically increase. So if you buy an option for $100, right, and the premium is like however much profit, the value is on top of it. So say you have a premium of 150 on it, so that means you profited 150. You could hold it, you could profit more, or you could sell it. Or if you hold it and AMD you think is going up, starts spiking down, goes all the way to 40, your option will expire worthless because people think there's no way it's going to make it to 50 by Friday, essentially. So really, the date can be your best friend or your worst enemy. So that's why you always want to buy time on your options, right? So we're in AMD right here. So if we go buy, call, so buy, there's two things. You're probably wondering why is it more expensive at the bottom? That's because those are in the money. So in the money means you're already right. So AMD is already at 47.64. So if you buy an in the money call, that means you're not exactly safe. If AMD drops, you can still lose money on your contract, but you will profit faster than an out of the money call, which is above the strike price. The strike price is whatever the company is at that certain moment. So if you go up, that's out of the money. That means it hasn't hit that price yet. Same thing for put, but it's the opposite direction. So put, you think is going down, so you would buy it at the higher price already. So that means you're already in the money. AMD is already below that. Call, if you're in the money, it's already above that. So put, say if you buy a $185 put, why I'm saying $185 is $1.85 is because you have to buy 100 shares of it. So you see when I press 1, that's 185. So I don't know how profitable this put would be. It depends on the volatility. You can press on the little bid thing, see how many people want it. That's pretty much how popular option is, and how much you can make off of it. So usually I stick to like AMD, Apple, Tesla, things like that, the options people want. So that's the basics of trading an option. Like that's literally what it is. Now, certain factors that you can lose money is if the stock downtrends and you think it's going up, even if you're in the money, like you already bought it, AMD's already above like whatever, $47, what is that? So say I buy this in the money call 46, so 46.50. AMD is already above that. If AMD starts spiking downwards, people get scared. So people think that AMD is going to go below that. Then your in the money call becomes out of the money and you lose money. So you can only lose however much you bought the contract for. So if we go to one of my contracts, if we go to a Apple one, so I bought the contract for $100, 100 plus 83, so like do the math, it's like $105. So I bought the contract for $105. So since I'm down $83 on it, I only have $19 equity. So if I were to sell this contract right now, I would get $19. I wouldn't get the 105 back. So the 105 you're putting in, you have to be okay with losing it if the stock goes the opposite direction. I don't know what the market is doing. Like it's honestly like crazy. So like I'm profiting on some calls, profiting on not profiting on others. So the thing is, you can't lose more than what you put in. So if you put in 100, then you can only lose 100, but you can lose all the profit on that option. So like if you profited like 100, you would first lose that 100 that you profited, so you could sell it at break even, which is $100. So you wouldn't lose any money, you wouldn't make any money, or you could lose the 100 that you bought. So really, there's two levels: profit. It takes all the profit, and then takes what you paid for it. So that's the basics of how to trade options on Robinhood. Give this video a thumbs up so it helps everybody who's confused, and don't worry about the break-even price, the strike price, things like that. It's only if you want to exercise the option. If you want to just trade options, then this is what you need to know. So yeah, if you enjoyed, subscribe to the channel, please. So yeah, see you guys.